Hi everyone, this is Sudeshna and today I'm going to speak about portfolio management. So starting with what is portfolio management? Portfolio management involves building and overseeing a selection of investments that will meet the long-term financial goals and risk tolerance of an investor. Active, so there are two types of portfolio management. Active portfolio management requires strategically buying and selling stocks and other assets in an effort to beat the broader market. And passive portfolio management seeks to match the returns of the market by mimicking the makeup of a particular index or indexes. So how do portfolio management work? Professionally licensed portfolio managers work on behalf of clients, while individuals may also choose to build and manage their own portfolios. In either case, the portfolio manager's ultimate goal is to maximize the investment's expected return within an appropriate level of risk exposure. Portfolio management requires the ability to weigh strengths and weaknesses, opportunities and threats across the full spectrum of investments. The choices involve trade-offs from debt versus equity to domestic versus international and growth versus safety. So the key elements of portfolio management. The first element is asset allocation. The key to effective portfolio management is the long-term mix of assets. Generally, that means stocks, bonds, and cash, such as certificates of deposit. Uh, there are others, often referred to as alternative investments, such as real estate, commodities, and derivatives. Asset allocation is based on the understanding that different types of assets do not move in concert and some are more volatile than others. A mix of assets provides balance and protects against risk. Investors with a more aggressive profile weight their portfolios towards more volatile investments such as growth stocks. Investors with a conservative profile weight their portfolios towards stabler investments such as bonds and blue chip stocks. The second element is diversification. The only certainty in investing is that it is impossible to consistently predict winners and losers. So, the prudent approach is to create a basket of investments that provide broad exposure within an asset class. Diversification is spreading risk and reward within an asset class. Because it is difficult to know which subset of an asset class or sector is likely to outperform another, diversification seeks to capture the returns of all the sectors over time while reducing volatility at any given time. Real diversification is made across various classes of securities, sectors of economy, and geographical regions. And the last element is rebalancing. Rebalancing is used to return a portfolio to its original target allocation at regular intervals, usually annually. This is done to reinstate the original asset mix when the movements of the markets force it out of kilter. Rebalancing generally involves selling high-priced securities and putting that money to work in lower-priced and out-of-favor securities. The annual exercise of rebalancing allows the investor to capture gains and expand the opportunity for growth in high-potential sectors while keeping the portfolio aligned with the original risk or return profile. So as I said, there are two types of portfolio management, passive management and active management. Passive portfolio management is also referred to as index fund management. The portfolio is designed to parallel the returns of a particular market index or benchmark as closely as possible. The purpose of passive portfolio management is to generate a return that is the same as the chosen index. In a passive strategy does not have a management team making investment decisions and can be structured as an exchange traded fund, a mutual fund, or a unit investment trust. Index funds are branded as passively managed rather than unmanaged because each has a portfolio manager who is in charge of replicating the index. And because this investment strategy is not proactive, the management fees assessed on passive portfolios or funds are often far lower than active management strategies. Active management, the investor who allows an active portfolio management strategy buys and sells stocks in an attempt to outperform a specific index. An actively managed investment fund has an individual portfolio manager, co-managers, or a team of managers all making investment decisions for the fund. The success of the fund depends on in-depth research, market forecasting, and the expertise of the management team. That brings us to the end of today's slideshow. Thank you.